When you want to acquire something, you need to exchange that commodity with cash. Okay. So the second function of the money is the unit of account, which means to say all values of commodities and services are measured through money. Just like, for example, if you want to buy a brand new car, the price of that car is expressed in monetary value. Okay. The third one, it is a store of value. It's just like cash is a representation of a wealth. Okay, so people can transfer the wealth or acquire something, and that wealth of cash has a purchasing power. Okay, so those are the three functions of money. Let's go to the kinds of money. The first kind that we will try to understand is the commodity money. From the term commodity, it is a precious, say for example, a precious metal like gold. So gold, in general, derives its value by itself. It means to say it has an intrinsic value. It doesn't have to be declared by government because gold or other precious metals has its own value. Okay. By itself. Okay. Second one, we have this what we call fiat money. Fiat money is a piece of paper produced by government, by the central banks, and this piece of paper, after the government declares guarantee or responsibility for this piece of paper or any kind of material, becomes a medium in exchange, and we call this cash or money. So by technical term, it is called fiat money. Okay, so the value is derived from the declaration of the government. Okay, so the supply of cash in the market is very important. Okay, as we say in economics, economics would always encourage people to buy or circulate the cash because by circulating cash, we also try to improve the profitability of business, and if business are profitable, then the economy will grow. Okay, so supply of cash in the market are represented in two basic terms. Number one, we have this what we call on-hand currency. Okay, these are the dong that are available in the market, and of course there's also what we have those dong or cash that are in the bank. Okay, so we have an on hand, which means to say people who are holding cash in dong, they will circulate the cash by buying in the market. And we also have this what we call deposited in the financial institutions. Okay, so those are the basic situations wherein you can find cash or money. Okay, so let's go to the supply of cash. Okay, and how the supply of cash are being used by central banks, or how the government creates policies to decrease or increase the supply of cash. Okay, so let's begin with the first one. If government wants supply of cash to be reduced in the market, the government will increase the interest rates on bank deposits so that people will be encouraged to put their money in the bank. And once the people already have deposited their cash, then this is considered to be a demand deposit. So what do we mean by demand deposit? Demand deposit means the cash that you have in the bank can be withdrawn anytime and there's no restriction. Okay, so if you needed any amount of dong, you just go to the ATM machine or the over the counter, and as long as your account has a balance, then the bank will give you the cash. And after you make the withdrawals, you also spend the money in the market, or the again go back to the circulation. Okay, so another thing, it says deposits represents a value, or like say for example, when we say savings deposit, usually it represents a small amount of cash that you deposited in the bank. Other kinds of deposits, we have this what we call time deposit, and due to its name, time deposit, it means to say you cannot just easily withdraw the money. There's a time duration, or there's a specific date wherein you can withdraw the cash. Okay. Some other accounts, we have corporate. Corporate means bigger account. These are checking accounts of corporations in the bank. So all the cash that they generate from the business, they also deposit it to a financial institution. And some other types of, let's say for example, short-term money market. Just like for example, you have a money market deposit. Um, let's say for example, maturing in 3 months or less. Those are considered to be liquid assets, okay, that are available anytime. And mutual funds are also available. They're also a source of cash or money for people or investors. Okay, so the next thing that we will try to understand is the central bank and the role of the central bank and the monetary policy. Okay, so every government around the world has a central bank. Okay, the central bank is a government institution given the power and authority to create policies related to monetary policies or adjustments that the government will do. The policies are also regulated by the government and monitored by the government. So basically, if we talk about the central bank, it is an institution that has a very important role to play in the financial system. So again, the central bank will create policies. The central bank will implement the policies. The central bank will regulate it, and if there's a need to change the policy, the central bank will also change it, and it will also supervise and monitor all financial institutions within the country. Financial institutions means banks and other non-bank financial institutions, just like credit companies. They are not banks, but they are part of the financial system. Okay, so what do you mean by monetary policy? A monetary policy is a rule or rules created by central banks to monitor the supply of cash in the market, just like what I stated earlier. Central banks will create policies to increase or decrease the supply of cash, because if there's too much cash in the market, as I have stated, the prices will go upward and inflation is not very good. If there's also very less supply of cash in the market, the deflation will also happen. So it's not a good thing for business and economy in general. So the objective of the central bank is to always analyze, understand, and monitor what is the impact of the supply in terms of inflation and in terms of how people are coping up with the changes in the supply of cash. Okay, so regularly the central bank analyzes the situation and adjusts accordingly. Okay, in the U.S. Setting, they call the central bank the Federal Reserve. Okay, or federal funds if we are talking about the money or supply. In every state in the USA has its own Federal Reserve. Okay, so the structure of the Federal Reserve in the USA composed of Board of Governors. They also have 7 of them. They also have regional federal banks, 12 federal banks around in the USA, and they have this what we call a Federal Open Market Committee. Okay, so later I will discuss the open market. Okay, so in other countries, just like in Philippines, the central bank is represented by the governor of the central bank. He's the highest official of the central bank, and we also have central bank offices in the regions, and I think it also applies with Vietnam. Okay, so the next slide talks about reserves. Okay, so what do you mean by bank reserve? A bank reserve is the amount of money required by the central bank to be deposited by financial institutions in the central bank. Okay, so internationally we have this what we call the Basel Accord. It is an agreement by different governments around the world to make banking uniform to every country around the world. So one of the policies or rules created by the Basel Accord is all about reserve. Okay, so how much reserve should a bank deposit in the central bank? Okay, so the amount is not uniform with everyone. Okay, there is just a suggestion. Okay, just like for example, they say 10% of the total deposits or cash assets of the bank should be deposited at the central bank, and other countries will also apply maybe from 8 up to 12. Okay, so but there is a standard suggestion, and it means to say that if we have $500 million total deposit in your bank, 50 million should be in the central bank, deposited as a reserve. Why do we need to have a reserve? Very simple. The reserve acts as a buffer or acts as a security or protection for banks in cases of liquidity problems. Um, Bankruptcy problem is already a big issue, so we just talk about the liquidity problems. Just like for example, if the bank has a problem with cash and there's no available cash in the bank, or the deposits are very low, they can actually ask the central bank to provide liquidity. That's why reserves are very important. Okay, and it says the reserve ratio is monitored by the officials of the financial institution, and of course audited and also monitored by the central bank. So it means to say, as the deposit increases, your reserve will also increase. If your deposit will go down, then the reserve will also go down. Just like for example, if today your deposit is 500 million and the requirement is 10%, that's 50. By the next week or the next month, the deposit will go to 400 million. Then deposit reserve requirement will also go down, maybe 40 million, because that's 10%. So every now and then there must be monitoring that is happening within the bank deposits. Okay, so the simple process of acquiring cash or money by the bank is through deposit. Okay, so once the bank accepts deposits from the depositor, just like what we do in accounting, we prepare an entry or a T account, just like in a regular business. When you receive cash, it is an asset. Okay, you put it in an asset and you exchange the asset with any other account, just like for example sales. You receive the cash from the sales, and at other times maybe a profit or revenue account. In banking, it will be the opposite. Okay, so once we receive cash from the depositors, of course we have a cash asset. Automatically we set up a liability. So all cash deposits are liabilities of the bank. So when you talk to a banker, when you say we have a lot of cash, it doesn't mean to say it's very positive on the bank, because the more cash deposit we receive from our customers or our depositors, the higher the liability or responsibility, because we have to give back the cash to them plus the interest that they should earn from the deposit. Okay, our asset in the bank is mostly loans that we provide, and the loans come also from the deposit of the customers. Okay, so just like for example, let's have this banks and the money supply situation. Okay, so you have a currency, and the currency is deposited into your bank. Let's say for example 1,000. Okay, by the banking system, the deposit received must also be circulated in terms of a loan, and part of the requirement once you receive it is to actually put aside the 10% or whatever the requirement of the country central bank, and deposit it into the central bank of that country. Okay, so basically this is how things are being done in terms of money supply. So it's just a daily transaction. You deposit part of the deposit, you reserve as a requirement for the central bank. Then the 90%, after deducting the 10%, will become now a loan. Okay, or you how to say, you transform the asset, the cash asset, into a loan, so that you also earn interest from loans, and the banks will become profitable. Okay, so if there's no banking system, then it's very impossible to create money supply and at the same time multiplier. Okay, because once I receive, if there's no bank and you just hold of your cash on hand, then it's just like having cash, then you buy, and then it circulates. It doesn't multiply. Okay, unlike in the bank, that when you deposit you earn interest, and the bank will also earn interest from the loan transaction. Okay, so the banking system or the financial system is very important. Okay, and looking at the slides, if you look at it, once the bank receives the deposit, the $100 or the 1 million or the $1,000 that they receive from the customer is automatically becomes a cash reserve inside the bank. Without any loan transaction, the cash will be the same. Okay, so it will not increase in value. And the problem later is that after a certain period of time, you have to pay interest on deposits to the customers. So if you don't have a loan activity, then it becomes a problem how to pay the interest plus the principal amount. Okay, but if the banks will go into a business transaction just like the loan, automatically they will allocate the amount of deposits, just like what you can see in the slide. We have here $100 deposit, $10 goes into the reserve, and the $90 will go into the loan activity. They will lend it out to customers or people. On the liability side, you have $100 obligation to your customers. Okay, so how does the money grow? Okay, how does the supply of cash, or just like for example a simple deposit transaction will grow? Okay, of course, number one, on the part of the depositor, the money grows through the interest that they receive. Okay, on the part of the bank, the money grows through the loan activities. Just like in this slide that we have, if I lend out $90 and I charge 10% interest on loans, after that period I will receive $9 extra as a profit. So my money will grow from 90 into 99 US dollars after a certain period of time. Okay, so second one, it says if we have $90 liability as a second example in the slide, then we have a 10% reserve required by the central bank. Then the only amount of cash available that we can lend out is only 81, because 90 multiplied by 10 is $9. Okay, so you have to set aside the $9. And as the amount changes, the reserve requirement will also change in value. Okay, it's not permanent. Okay, it's not a specific amount. The rate of reserve might be specific, but the value keeps changing because the deposit daily will change. Just like the cash on hand at the end of the period of the bank will also change every day. Okay, and they also have another example. If the reserve is 81, how much is the amount for central bank reserve and the loan amount? So as I've said, as the value decreases, the amount of reserve and the amount of cash for loan also changes. Okay, so the next example tells us the process. Okay, so let's say for example here, created by each new loan. Okay, so we have this what we call refinancing. The banking term is refinancing. After you receive the payment of a loan, principal plus the interest, the next process that the bank will actually do is to lend this money again to another customer or to the same customer. So the cycle will keep continuing until a customer decides not to avail of a loan anymore. But on the part of the bank, it will continue and continue and continue, because that is the basic source of banks' income or profitability. So after they receive amortization or payment from the customers with their loans, the bank will also push this to another borrower, and the cycle will never stop, because this is how they make money. Okay, so when you say money multiplier, as I have already mentioned earlier, the multiplier is represented by a rate of how much you will earn and how much the bank will also earn. So as the interest goes higher, the multiplier will also go higher. Okay, and in fact, in banks right now, in many countries, they offer a financial product called money multiplier. So it depends on the amount, and it depends also on the timing. Just like, for example, some products that I have seen during my banking years, we have this what we call double your money multiplier. So if you deposit a certain amount, after let's say 1 year or 2 years, that amount will become double. It's like, for example, you have 10,000 US dollars, and after 1 year, you wait for a year, it will become $20,000. So every bank around the world, they have their own interests, and they have their own way of creating multiplier. The longer is the term, the higher is the multiplier, because usually short-term time frame of multiplier carries also a very small interest rate. Okay, so for the activity, we have here a 50 peso bill, and the reserve requirement is 20% of deposit. There are some questions. Okay, so what is the maximum amount that the money supply could increase? What is the minimum amount that the money supply could increase? Okay, so basically, what happens is that you have this 50, and when you divide it by the formula 1 over the rate, when you divide it by 1 divided by the 20%, it looks like that the multiplier is 5. Okay, so it means to say the 50 can be multiplied into 5, because the reserve requirement is 20%. Okay, so it means to say, as you use the 20% reserve requirement, there's also a possibility of making it 5 times. Okay, so the objective of the bank also is to maximize how much they can multiply the money. Okay, there are also other examples in a checking account. Okay, so just like this one, the checking account is basically an account opened by corporations or individual to make payments from the check. So you look at the example, the checking account has a 200 multiplier. Okay, next one, the central bank uses tools to control the money supply. One of them is the open market operation. What do you mean by open market operation? The central bank or the government participates in the supply of cash by buying or selling investments. Just like, for example, government bonds issued by the any government institution. So if the central bank or the government wants the supply of cash to change, they can either sell a bond, which is an investment. After selling the bond, the cash will go to the government. So when the government notices that inflation is very high and the supply of cash is very high, they use the open market operation to sell investment, and the people will invest, and the cash will go into the government from the investment of people. If the central bank also notice a opposite situation, the central bank can actually buy the investment from people. Just like, for example, if the supply of cash is not enough and creating a deflation, what happens is that the government or the central bank will buy the investment that they already sold to people, let's say, for example, like a few months ago or 1 year ago. So they will buy it back so that the investment will come back, the obligation, and people will receive cash from the investment, balancing the supply of money in the market. And this this open market operation or system are used by many government institutions, because especially in a democratic or open type of economic system, the government cannot impose policies that will really control the supply. Okay, so they participate in a more democratic and open market. So they just buy and sell, buy and sell. Do not touch any other policies, because when you deal with other policies, it's like changing the interest rate or changing the reserve. It becomes more complicated, especially the reserve, because the banks will also react to it. Remember that the higher the reserve that you will require the bank, the less amount they will have available for loans, and the lesser profit they will create. So it's a complicated situation. Okay, and U.S. governments are very active participants of the open market system. Okay, so in terms of reserve requirement, as I have said, if the central bank feels that there's a lot of money in the system or in the market, they can also change the reserve requirement. Either they increase or they will decrease. Okay, so once the government increases the reserve requirement from 10% to 50%, automatically the financial institutions will have lower amount of money for loans, because the 15% is deposited in the central bank and they cannot use it. That's the policy. Okay? They can also do the other way around. The central bank will reduce the reserve requirement. So from 10%, they make it 7%. So there's extra 3% available for loans for the bank. So they just, they just change the requirement according to the need. Okay? If there's a need to do it, then they do it. Some countries require approval, just like, for example, from Parliament, if the country is really very close and very tight, or it requires approval from the president through a decree. But many other countries, the central banks are given power to make the changes. It's like in Philippines, it's usually the central bank who will decide. Okay, so a discount rate is another tool that the central bank uses to change the supply of cash. Okay, so what do you mean by discount rate? The discount rate is interest rate. Okay, so discount rate might be represented by, or are represented by, the rate of loans or the rate of deposits. Okay, so these two work together. Okay, so the banks will usually attract customers by increasing their interest rate on deposit. The higher the interest rate, the more they generate cash from customers, because customers are attracted with the income, potential income that they will get from the bank. On the other hand, the bank also make sure that they make make enough money or profit by the interest rate that they impose on the borrowers. So these things are a challenge for the bank, because you cannot just simply increase your interest rate and deposit, because it is a liability, it's an obligation to the customer. On the other hand, you also cannot increase too much your borrowing, because it will discourage borrowers in general. So you have to keep a balance. How much is the amount really that is attractive to your customers? So every now and then, especially in a floating type of financial system, they will adjust the interest and deposits and interest and loans regularly. In some other countries, they have a fixed one. So for 1 year or 2 years, same interest rate. But countries that are actively participating in the open market, they will adjust regularly. Okay, so the Federal Reserve, the central bank has the power to change the interest rate. If the central bank feels that deposits are required, they will ask the bank, through the power of the central bank, to instruct or give instruction to the bank to increase your deposits. They will have a ceiling in the floor. How much is the maximum and how much is the minimum amount of interest rate? It's the bank who will decide which interest rates from floor to ceiling they will apply. Okay? So what is the objective? Central bank wants to influence or control the supply of money. So it's up and down in terms of interest rate. And the federal funds, or the cash available in the central bank, is also another source of control. Just like, for example, if the central bank feels that the financial institution needs funding, they will also decrease the interest rate of the borrowing in the central bank. So especially if we have a problem with money supply and there's a few supply of cash in the financial institutions or the banks, the central bank will help, because the central bank has a lot of reserves in their custody, or in their how to say, in the custody of the central bank. So if they would like to encourage more supply, they will just decrease their interest rate so that the banks or financial institution will borrow from them. Okay, so that's how they control the supply. And the federal funds reserve or rates, reserve and the borrowing rates have been fluctuating over decades. Okay, so what is the reason for fluctuations? The reason for fluctuation is that the central bank is addressing the current issues. As we say, economic policies done by government, the central bank will support by way of a supply. So if the government feels that there must be infusion of funding or cash in the market, then the central bank will do its part. So it keeps fluctuating over time, because economic conditions are also not fixed. They're not permanent. They keep changing over a period of time. Just like, for example, what's happening right now with the virus. A lot of stock markets are down, okay, and business is not very good. So basically, if this problem continues, then later on the government will create a fiscal policy to address the problem, economic problem, and the central bank will also play its role through the monetary policy. Maybe later, if businesses or economic conditions are really down, then the central bank will infuse capital into the market so that the economy will continue to operate. Okay, so monetary policies in central banks are essential, okay, especially for stability and continuous growth of any economic situations or conditions in every country around the world. Okay, so what is the problem? Let's discuss some problems relating to controlling the money supply. Okay, it says here, if household hold more money and fewer reserves, then I think the supply will also be a problem. Okay, so basically, we don't like people to keep money at home. Money should be deposited in the bank. And it says another problem, if the reserve I mentioned earlier keeps increasing, then the problem with supply will also decrease. And these two things must work together, the people and the financial institution, so that the supply of cash will be in good balance. Okay. Another issue that we can encounter is what we call a bank run. Okay, what do we mean by a bank run? If a country, or let's say for example, we'll start with a small one. If a bank has a problem with cash and the bank is not able to solve the problem, this might create an issue among its customers, and the customers will have fear that the bank will go into bankruptcy. So what will happen is that a huge number of customers will flock into the bank and withdraw or close their account. So imagine if all customers will close their account, automatically the bank will close down. So it's an issue or problem that every country is trying to control. So one of the things that you can control the bank run is to make sure that you're financially stable and liquidity is always available, which means to say the bank must operate profitably, and at the same time there's always a cash available if the customers will go to the bank. Okay, and avoid issues or scandals that will put the name of the bank at risk or in question. Okay, so that's why you notice that bank operations are very, how to say, confidential. At the same time, compliance with rules and regulations are very strict in the bank because of the danger of bank run. Okay, and in history of banking, there's already a lot of cases wherein there are bank runs that happened, especially in the USA. It's like during in period of 20s, 1920s, and some other decades that the bank run happened. And this case in the USA was brought about by the depression, the economic depression. A lot of business went into bankruptcy. That's why we also expect the bank to close down or have a bank run problem. Okay, so that's the entire topic of the chapter 5. Let me conclude the chapter. Okay, so number 1, it says the money as an asset is very important. Okay, because business use cash or money for business transaction, and the currency includes on hand and at the same time bank deposits. Federal Reserve is an institution, or central banks are institutions that are mandated by government to control, to monitor and regulate supply of cash, and at the same time regulate the activities of banks in their countries, respective countries. The central bank controls the supply of money for economic reasons. We try to control inflation. We try to control supply so that people will not be greatly affected, especially during increasing of the prices of commodities or inflation time. Okay, so if you have some issues or questions about the week 5 lesson, which is about monetary system, you can send me an email addressing the question. Okay, and I will try to reply by email, or maybe I will create also another video answering the question that you will send me. And for the meantime, I will send you some notes or slides, and if the cancellation classes will take longer, I might probably send you some activities that you have to work on, just like quizzes that you will do in your home, because right now we don't have a choice but to stay at home. Okay, so make sure that you follow the government's instruction about keeping safe. Okay, avoid going around in your hometowns to avoid the spread of the, or to avoid situations wherein you're exposed to the virus. Okay, and always keep hygiene as your priority. Okay, so let's communicate regularly to email and some other means. Okay, and I will see you in the next video if we don't have classes. Enjoy. Thank you.